Welcome to the Greatest Lessons series. I'll highlight the most important lessons taught by Benjamin Graham by using my longer videos to showcase them. This episode is on the Defensive Investor Guidelines. And as always, if you enjoyed the episode, liking the video, subscribing if you haven't done so already, and hitting the bell for notifications is greatly appreciated. With these guidelines, it's really about limiting the pool of choices. There's a lot of choices out there for stocks that you could potentially be buying. Benjamin Graham is trying to weed out the financially unstable companies through the guidelines that he's about to show. Because after all, it's much easier to find good companies when there's a lot less to go through. Another point with the defensive investor guidelines is keeping things simple. As a defensive investor, your primary goal is safe and adequate returns. You aren't spending as much time paying attention to the stock market. That's more of an enterprising investor style. It's simple as saving money each week. Lastly, before showing these, I just want to say these are guidelines. Ultimately, it's your money and your choice. This is just Benjamin Graham's advice for defensively selecting stocks that I found in his books. He's just trying to help. Let's watch a short segment of my longer series on Benjamin Graham. Now we'll get into the defensive investor section of this video, where there's very simple selection policies and guidelines from Benjamin Graham. In the Intelligent Investor, which includes 4 core policies, 7 selection guidelines. Some of the selection guidelines overlap and say the same thing as the core policies, but I'll cover them as they were presented in the book. I'll make some guidelines to help limit your selection pool so it's not so overwhelming. The first of our 4 core policies is adequate, not excessive diversification. And I'm sure we've heard this 10 million times, but here's Benjamin Graham's take. What is adequate but not excessive according to Graham? That's between 10 to 30 different issues spread across multiple industries. 10 to 30 investments? That's it? Don't forget that Benjamin Graham, from part 1 of this series, recommended about half of your investments being put into bonds. Not to mention, keeping track of 30 companies is very difficult for the defensive investor. The second is to keep choices large and conservatively managed. So what does he mean by large? That means sticking to the top companies in well-developed industries and avoid the mid to low capitalization stocks. These can theoretically give you better returns, but will need to be looked at more consistently, which isn't in the defensive investor's style, for the safe and simple long-term choices. Pick a small cap high growth stock. One of these 3 will do well, the others not so much. Oh man, the pressure. Then we have, what does conservatively managed mean? Ones that have their debt situation at a comfortable level. What makes their debt situation at a comfortable level? Well, if you haven't heard this enough, it's industry specific. A car company will be vastly different from a software company. The third of our core policies is to buy companies with amazing dividend histories of at least 20 plus years. Benjamin Graham is obsessed with dividends. He talks about them all the time in every single book that I've read. And he likely has a shirt that says I heart dividends, similar to those I heart New York shirts. Yeah, that would make a great shirt. Our 4th core policy is to buy only at a reasonable price. And this one is simple in theory but hard in practice. And as such, this is Benjamin Graham's advice for defensive investors. The investor should impose some limit on the price he will pay for an issue in relation to its average earnings over, say, the past 7 years. We suggest that this limit be set at 25 times such average earnings and not more than 20 times those of the last 12-month period. Buy this company that has $100,000 in earnings for $5 million? That seems kind of expensive. And just as a quick pause, if you would like to join Patreon, that would be greatly appreciated. Going into our 7 selection guidelines for the defensive investor, the first is the adequate size of the company. And as mentioned previously, if you want to be a defensive investor, then stick to the bigger companies with long and established histories. Going into number 2 is the strong financial condition. Companies that can handle their debts well are much safer than other choices. Number 1, current assets should be at least twice the current liabilities. And 2, long-term debt should not exceed the net current assets. Oh no, I'm not in a good spot. Next is stable earnings. See that your company is reliable with their earnings. 10 years where each year had increasing earnings. First year was 5, second is 8, third is 9, fourth was 4, but then year 5 comes and you get -3 earnings. But then the next year after that, it's 13% increase in earnings, followed by 7, 2, 5, and lastly 9%. According to Benjamin Graham, this would be a failure because even though the loss was negligible only at 3%, and then the recovery next year was up 13%, it still didn't have 10 consecutive years of increasing earnings. Fourth was strong dividend records. At least 20 years of payments going into the investors' pockets, preferably with dividends getting raised each year. For number 5, we want continual earnings growth, a minimum increase of at least 1/3 in per share earnings in the past 10 years. This is with using 3-year averages to calculate the beginning and end points. This way, you help reduce variance between the years. Slow and steady, right? Well, my company can go really slow. Too slow. Next. Number 6 is moderate price to earnings numbers. There's often a lot more assumed growth than real growth with high PE stocks. Sure, there are high PE stocks that can still give you great returns, but figuring out if the premium is worth it or not isn't something the defensive investor is good at doing. However, sometimes low PE stocks are indicative of 1. Poor financial condition, which likely won't be an issue if you're following the strict selection guidelines that Benjamin Graham is suggesting, and 2. Lacking future growth prospects, and this is where the qualitative nature of stock selection will come into play. It's possible that the company truly won't have good future earnings, but it's up to you as an investor to pick stocks that you believe in that will thrive into the future. I believe in you, even if those other people don't. Thanks, Benjamin. I really needed that. They keep saying I'm too slow, but they don't understand my potential. Generically, Benjamin Graham sets the PE maximum of 15 for defensive investors. However, this number is somewhat flexible if you read the annotations in The Intelligent Investor, which I did, and this is what it says. The stock portfolio, when acquired, should have an overall earnings to price ratio, the reverse of the PE ratio, at least as high as the current high-grade bond rate. This would mean a PE no higher than 13.3 against a AA bond yield of 7.5%. And how are these numbers connected? You just take 100 divided by 7.5, which gives you the 13.3 that he was talking about. So for example, when the average 10-year AA rated bond in 2003 was 4.6%, that means a Graham formula for this was the maximum of 21.7. Once again, 100 divided by 4.6 gives you 21.7. And as you can see, Graham's opinion of determining whether average PE numbers are moderate or not depends on what the average AA corporate rated bond yield is. Lastly, for our 7 selection guidelines, we have the moderate price to assets ratio. And this is where the selection rules can shift around a little bit. For a moderate price to assets ratio, Benjamin Graham says that the current price should not be more than 1.5 times the book value. However, there was also the blended multiplier. Ultimately, the product of the PE times the price to book should not exceed the number 22.5. And that comes from what he said previously, which was 15 times the 1.5. So the PE can be higher than the maximum stated previously, or the PB can be higher than the maximum stated previously if, when you multiply them together, the number is at or less than 22.5. Thank you so much for watching to the end of the episode. And if you're interested, consider joining with the Market Moves Investing Book Summaries link in the description down below.